Hi, this is Dan at Master Trader, and in this week's lesson for investors and active traders, we're going to use an example on COH, who has earnings coming up in a couple of weeks, just to show you the amazing power of very simple option strategies and how you can boost your annual returns on a stock that's in your investment portfolio just by using smart option trades into those earnings, which are 4 times a year. Just a general covered call program. This is our approach to it. We're looking for monthly profit in exchange for we're willing to give up the upside. So that increases the probability of profit and gives you an edge to be wrong if the stock is not continuing in your direction. Now, this is a monthly covered call program, but in today's lesson, we're specifically just focused on earnings, which are 4 times a year. Now, many people are buy and hold investors, and they're looking for their dividends. Now, there's risk to that, of course. The stock can go down, so you lose your capital, but also just the average dividend yield's only been about 2% over the last decade or so. So I'm going to show you how this strategy can create tremendously larger monthly returns on your investment portfolio. Now, we do this type of consulting for high net worth individuals and money managers, what I'm going to be showing you in this lesson, but also our options course. Our goal is to teach you how to manage your own account and generate the ongoing wealth and income. So we're going to use COH Inc., the high-end retailer, for this example. This is late July. Earnings are coming out mid next month. And as any strategy that we deploy at Master Trader, whether it's stock or option, everything starts with a compelling pattern. So we have the daily chart here on the left. It closed here with a beautiful breakout from, well, let's back up a little bit. Here in early May, it had a nasty breakdown. I mean, retail sector has been under fire here over the last couple of months, been very bearish in light of, Amazon and it killing these retail outlets. So this had a professional gap from that failed breakdown on huge volume, small retracement, another gap, no retracement at all, consolidation, 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 rising 20, rising 50, rising 200. Let's jump over to the monthly chart. Multi-year, big bottoming process, but this move right here in May was our wide range breakout on the monthly chart, and we have plenty of room to run. So this is a great candidate if you're holding it for a long-term investment. There's no reason at all to sell it. But back to our lesson here. Now, we split up these strategies because this is how we teach them in our 10-module option course. Everything starts with the pattern, and then you ask yourself, do you want a directional strategy, option strategy? And we have all of these listed on the left, which we regularly deploy. And then income option strategies, where you're just trying to generate income on calling a short-term top or bottom in a pattern where time decay is your friend. Now, even though earnings are next month on COH here, there's nothing wrong if you just want to swing trade this and not hold over earnings. There's nothing wrong with that. So I just highlighted in blue here the directional option strategies if you wanted to profit on a swing trade on COH. You could buy call options. You can buy a bull call spread. You can buy a covered call, which I'm going to show you in this lesson, a bull call diagonal. Those would be the popular ones that we would deploy if we wanted a directional long, and we are going to keep this on our watch list for that. Income option strategies shorting puts, and I'm going to show you an example of that, and a bull put spread. Those will be our main income strategies on that particular bullish setup. 26 days to expiration of mid-August. Let's start with a covered call. So assume you own COH in your portfolio. Earnings are coming up in 26 days. Many people don't like to sell calls under the crazy belief that, oh no, why would I do that? Because I'm giving up the potential upside. But let's work through the numbers, and you can be your own judge. Call options here on the left, puts on the right. We'll do that on the next example. So COH closed at 48.74. So for this example, you would sell calls 26 days to expiration, and this is a time decay strategy. The strike that you pick and the expiration that you pick, as always, those are trade-offs between the amount of money you're putting in your pocket immediately, the bird in the hand, and what strike price you're capping your gains. And we obviously teach that in great detail, and we explain it in our services, of course, when we recommend trades. But let's continue with the ones that I'm highlighting here. So the August $50 call option on COH is 95 by 115. We always put our orders in for at least midpoint, so that would be $1.05. Well, I wrote 115 here, but it's actually $1.05. So selling the $50 strike, let's assume we get filled there, it would cap our gains at the strike price. Because what is selling a call? Let me back up. We're assuming you already own COH. Now, you are selling a call option against your stock you own, and that's called a covered call. So you are putting money in your pocket in exchange for agreeing to sell your COH shares at the $50 strike price on or before expiration, which is 26 days from now. You're putting $1.15 or $1.05, if it's the midpoint, in your pocket per share. So on 100 shares, that's obviously $115 per 100 shares. If you have 1,000 shares, that would be $1,150 going in your pocket. But just focusing on one share for this math. So our maximum gain, since we agreed to sell it at $50, we've already put $115 in our pocket. So that's our cost basis. We've improved our probability of profit all the way to that point. So as long as it doesn't go beyond that, we've made the maximum amount we could. But even if it does get taken away, we're generating 4.94% return on investment in 26 days. And I just put in parentheses here, the math, so you can see how I got that. It would be the cost that I'm selling it at, my maximum gain, less where the stock is trading now, divided by that, and I get almost 5%. So if you annualize that, and again, keep in mind that I'm focusing on just doing this 4 times a year. Although, as I mentioned, we consult and we teach people how to do it every single month. But I'm just showing you these incredible returns just 4 times a year, 3 to 4 weeks before earnings. So if you multiply this times 4 for 4 quarters, and this is only 26 days, you're close to 20% additional return on your COH stock. It's an amazing math. So that's why I write here. Do you want the bird in the hand of this 4.94%? Or do you want to be this pig and say, oh no, I want more than 4.9% in 26 days? Well, we all know the saying about pigs on Wall Street. They get slaughtered. Same example, but now let's look at the math of shorting an out of the money naked put. So the calls were on the left, puts on the right. Same 26 days to expiration. Stocks trading at 48.74. So let's just jump down for this example to sell the $47 put. Now that is $1.74 out of the money. And I'll show you the math in a second. So what does that do when we sell a put? We're putting money in our pocket. So let's use 90 cents for this share, for this example, 15-cent spread. We're putting 90 cents a share of profit in our pocket immediately. As soon as you sell this, 90 cents a share goes in your brokerage account. What is your obligation for that? It's to buy COH at the strike price on or before the next 26 days expiration. And you have that legal obligation because of the premium. It's the same risk to reward as a covered call, but it's a time decay income strategy, the same. So I'm just showing you this as an alternative to the covered call. If you didn't already own the stock to sell the call against, and you said, "Hey Dan, I love that pattern. I wouldn't mind owning COH at an improved cost basis," then this is a strategy for you. Let's look at the math. So 90 cents a share gives us a cost basis of what? If we're obligated to buy it at $47 a share, we've already put 90 cents in our pocket, then my cost basis, if I'm required to buy COH, is $46.10 a share. Let's do the math on that. The margin when I sell a naked put is 20%, roughly. I'm not going to get to the penny. 20% of the strike price. So what we do is take the 90 cents divided by 20% of the strike price, and that gives us a 9.5% return on margin for selling these naked puts. Plus, here's one more benefit. When I refer to cushion, you have a 5.4% cushion that COH can go against you before you start losing money. How do I calculate that? Well, if your cost basis is 46.10 and the stock's trading at 48.74, you take the difference of those two, divide by 48.74, and the stock can drop that much. And this is for a 26-day play. So you can, do your own math on that. Same thing, bird in the hand or a pig. I hope to have changed your conclusion on that if it was other than bird in the hand. So these strategies that I mentioned back here, all of these and more are taught in our Master Trader Option Strategy series for investors and active traders. A to Z 10 module amazing course. And we want to teach you how to fish, how to come up with your own trading strategies to generate ongoing income and wealth. Hope that helped. Have a great trading week.